Hello guys, welcome back. Today we're going to talk about the capital budgeting and managerial decisions, which is chapter 25. So, capital budgeting and managerial decisions are very important for your ATE assignment, as well as it's important because we will find out a lot of nice investment tools in order to make better our investment decisions. So what does it mean? It means simply that we need to find out, for example, how long it will take before your investment will pay you back your money which you invested, or it will also depend that how your accounting rate return will be on your investment as well. And in this chapter, we're going to learn only two main key measurements because in your ATE assignment, you need to calculate only these two things. Normally, this chapter is quite long, but because we are concentrated nowadays to do your ATE assignment very good, I want to teach you only what you're asked there, because when you're going to learn finance for managers 2, for more advanced finance, let's say, you will learn more tools there. So here I want to teach you only really basics and to make your life also easier. So in this chapter, it's really very short for us because we're only gonna cover two procedural things: how to compute payback period, and we're gonna talk about it, and how to compute accounting rate of return. Okay, so it's really short chapter this time, but it's really useful. So, you know, in this case, let's say quality matters more than quantity. Okay. So if you're going to understand these two things, I'm sure you will understand how to do your last task on ATE assignment. But of course, you need to read it from your book to understand idea of what is it. But from procedural part, we're going to compute the payback period and ARR, which is accounting rate of return. So let's start. In general, what is capital budgeting? Capital budgeting is a process of analyzing alternative long-term investments. And after that, we need to decide in which assets we will acquire or sell. So all this chapter normally is about investments and capital budgeting, okay? And this process, capital budgeting process, has the following steps. First of all, the plant managers, they are submitting proposals. For example, I have proposal to buy this kind of asset, I have proposal to sell this kind of asset, so different proposals, let's say. After, there's a capital budget committee which evaluates your proposals, and finally, board of directors approves capital expenditures. So question here is, how they evaluate your proposals? To evaluate your proposals, they have different measurement tools. But as I told you, in this chapter, we're going to cover only two main measurement tools, okay? Okay, we have cash outflows and cash inflows over life of typical capital expenditure. So what are cash outflows? First of all, first outflow is the acquisition. When we buy an asset, we have an initial cash outflow. When we use an asset, we generate cash inflows from revenue, because when we are using assets, we have different kind of revenues. And finally, when we dispose the asset, if it has a salvage value, we can have a cash inflow, because if we're going to sell it, we're going to have cash inflow. So these are three main, let's say, sources of cash incomes and cash outcomes. So once we understand these basics, from where we have a cash incomes and cash outcomes, and once we know that these cash outcomes and incomes in numbers, we can start computing the payback period and accounting rate of return. So let's start from payback period. So it's a P1, which is probably like procedural part 1 to compute payback period. So payback period tells you around how long it will take your project or investment to get back money which you initially invested in the project. What does it mean in other words? So let's say I'm projecting to open new coffee shop and I'm investing 10,000 euros on it. So in this 10,000 euros, I would like to know how long it will take around for me to get back this money. How many years or how many months it will take me to get this money back. Okay, this is payback period, sorry. Payback period has a formula when we have even cash flows. It's a cost of investment over annual net cash flow. And of course, the managers always will prefer to make investments in the projects which has shorter payback periods. You might ask me why. Why? Because it's very simple. When your project has a short payback period, it means that you're going to get back your investment very soon. Okay? So that's why, of course, they prefer to invest in shorter payback periods. Okay, so how we compute payback period with even cash flows? Because there is even cash flows and uneven cash flows. The difference is that with even cash flow, we know how much money we are getting every year. It's the even number, so it's always the same, okay? And we have uneven cash flows, which means we have different amounts every year. We're going to discuss both of them. First of all, here's the example. Fast Track is considering buying a new machine that will be used in its manufacturing operations. The machine costs $16,000 and is expected to produce annual net cash flows of $4,100. The machine is expected to have an 8-year useful life with no salvage value. Calculate the payback period. Okay, so what is happening here? We are considering to buy a new machine, which we're going to use in order to manufacture some products. And today we are paying $16,000, which will give us $4,100 per year cash inflow. And the machine having an 8-year useful life, and there is no salvage value. So we will calculate payback period. So now we need to use the formula which I showed you in the previous slide and to calculate the payback period. So payback period, as I told you before, is a cost of investment over annual net cash flow. So what is the cost of investment in our case? In our case, cost of investment is 16,000, right? Because we are paying 60,000 today. And what is annual net cash flows? 4,100, because we will get 4,100 every year for 8 years. So how long it will take for me to get this money back? If I'm going to put these numbers, I'm going to get 3.9 years. So around in 40 years, let's say 3.9 is almost 4, I'm going to get money back, which means that around in 40 years, I will have my $6,000 back. So my investment will pay me back my invested amount of money in 4 years. This is a payback period. And in ERAT assignment, you also have to calculate payback period. Okay. When we have even cash flows, everything is easy and nice because it's a very easy formula. But unfortunately in life, or fortunately, not everything is ideal. So normally we are not getting always even cash flows. That's why there is a second method which is called computing payback period with uneven cash flow. So uneven cash flows means that we have one investment again, but your cash inflows are different every year. And here is an example. So example is the following. In this example, as you can see, we have expected net cash flow and cumulative net cash flow. What does it mean? So expected net cash flow is a cash flow which we're gonna receive in the future from our investment. For example, if we want to install a machine which costs $16,000 and has a useful life of 8 years with zero salvage value, today we are making investment which is negative number. So after our cumulative net cash flow is 16,000. What does it mean? It simply means that today for this asset we have 16,000 negative balance. So we invested 60,000 on that machine. Okay? In first year we have get money from the machine $3,000. So balance of my machine, net cash flow balance, is 13,000 negative, which comes from 16,000 minus 3,000 is 13,000. In year 2 I got more 4,000, so I have 9,000 negative number. Then in year 3 I got more 4,000, so my balance decreased to 5,000. And year 4 I got more 4,000 and my balance got minus 1,000. So in year 5, what is happening? Please pay attention. I'm getting more $5,000. And on year 5, you're starting to making profit, which means you're got your money, what you invested, 16,000, and you start to earn additional profit from it, which is 4,000. So the payback period will be between 4 and 5th year. So it's not 4 years because we are still having negative number. It's not 5 years because we have already positive number. So what is our task now? To find out exactly how long it will take for us to get money back which we invested in year 0 here, 16,000. How are we going to do it? Simply, if we're going to take 1,000, which is in beginning of year 4, which is negative number, and divide by 5,000, it will be 0.2. So what does it mean? It simply means that in your cash flow, cash net inflow, which is 5,000, 1,000 is only 20%. So let's say from 1 year it's 1 divided by 5, 0.2. Okay? So if it's 0.2, it means that my payback period will be 4 years and 2. So it will be 4 years and 2 to get back my money. So it will take around 4 years and 2 in order to get my money back. So that's how we're going to work about uneven cash flows. So we need to calculate them manually. Okay, so this is how it works. I hope it's clear enough, and if not, of course, please ask me a question and I will try to help you more. So payback period has advantages and disadvantages. I would say more strengths and weaknesses. So what's the main strength point is that it's very easy to use, because it's really simple technique. It uses cash flows, not net income. And so if we have a net income, we need to convert it into cash flows. And payback period has 3 major weaknesses. First of all, I would say is that it ignores time value of money. What is time value of money? The money has a value over the time. So for example, today's $1 is not same as tomorrow's $1, or yesterday's $1 is not same as today's $1. So money has a value over the time. So this principle, payback principle, ignores this concept. Also, it doesn't reflect differences in the timing of net cash flows. And very important is that it ignores all cash flows occurring after the point where investment costs are fully covered. So what does it mean? It simply means that, for example, maybe I'm getting my money back in 4 years, but I don't take into consideration what is happening after. So maybe my project is successful only for 5 years, but after it goes down, and it will end up. So this is weak point. It doesn't mean it's like bad or good, it's just weak point. And when you're gonna learn finance for managers 2, there you will study more techniques to evaluate projects, because this is only really basics. Here we talk about really basic things which we need to evaluate projects, but of course there is much more tools to evaluate project and investments. These are really ABC of investments, even I don't know, ABC, yeah. So this is all about payback period. Here we have a quick example about it. So we will do it together now quickly because I want you to see how it works. And then end of the chapter, I'm going to assign you some, let's say, problems to discuss, and you will see more or less same things. So here, company is considering to purchase equipment which has a value of 75,000. Future annual net cash flows from this equipment are 30,000, 25, 15, 10, and 5. Cash flow occurs uniformly during the year. What is an investment's payback period? So as you can see in this example, we have uneven cash flows. So we have 75,000 investment today, which has a cumulative net cash flow of 75,000. In year one, we have a 30,000 net cash inflow. So your cumulative net cash flow is 45,000 negative number. After in year two, you received more 25,000, and your cumulative net cash flow is 20,000. In year three, you received $15,000, so your cumulative net cash flow is 5,000. And in year four, you received 10,000, your cumulative net cash flow is 5,000. So what does it mean? It simply means that your payback period is between year 3 and year 4, which is true because in beginning of year 3 you're still missing 5,000, but in year 4 you already have 5,000 plus. So how I can know how long it will take it? As from previous explanation I told you, you need to divide 5,000 over 10,000, which gonna be 0.5. So I had a 1, 2, 3 years. So final answer will be 3 years and a half. Okay, just same what I did. You can see on the slides how they calculate it. 3 years and a half will take you to get back your 75,000 of investment. So this is practical work for your payback period. So now we're going to move to your second learning objective, which is part of your AT assignment, is called compute the accounting rate of return. So we're going to talk now about accounting rate of return, which is ARR. So what is ARR? ARR is measurement tool to find out the amount of net income generated from a capital investment. In other words, what is your return generated on your investment? Okay, so accounting rate of return has this formula. So annual after-tax net income, actually your net income after tax, over annual average investment. So as you can know from previous chapters and knowledge, we can always find very easily this information under income statement. What we need to learn today is how to find out annual average investment. And there is 2 ways for it. The first one is straight line case only, which means that whenever you have straight line depreciation, you will use this formula always, which is beginning book value of the assets plus ending book value of the assets divided over 2. So which means that your beginning book value plus ending book value over 2 to find out average investment. Okay. Second method, when it's general case, when there is no straight line depreciation, it's a sum of individual years' average book values, which means that if you have different book values in different year, you're gonna sum up them and divide by the number of book values you have. For example, if I have 10 different assets and it has 10 different book values, I'm gonna sum up them and I'm gonna divide by 10 to find out what is average book value. And we divide all this over number of years of the planned investment. So how many years has an investment useful life. Okay, in this chapter we're gonna mostly use this approach because it has straight line depreciation. Okay, so of course here quickly I will tell you that of course managers are preferring to find and choose the the projects which has higher accounting rate of return, because it means your net income generated from a capital investment is higher and it will give you more money. Of course, it makes sense, I hope. So here we have an example, just better to understand what I'm talking about. So we're going to go back and revisit the example when we had a 16,000 investment. A new machine has an annual after-tax net income 2,100. So we're going to compute the accounting rate of return. So accounting rate of return is your after-tax net income over annual average investment. So as I told you, here we are using straight line depreciation, if you remember from previous slides. So annual average investment will be beginning book value, which is 60,000, plus ending book value, because if you remember this example, they don't have salvage value, so ending book value is 0, over 2, which will be 8,000. So if I know my after-tax net income, if I know my annual average investment, then I can calculate my accounting rate of return by simply dividing 2,100 over 8,000, which gives me 26.25%. I'm sorry, it's not visible, my camera is hiding, but if you want to verify, it will be 26.25%. So what does it mean? It means that simply your return on your investment is 26%. So yearly, you're getting from your investment, which was in your case around, in average, you're getting 26%. Because if you remember, the payback period for this was, I think, 3.9, no? So if you're gonna more or less multiply it by 4, you're gonna get 104%, 105%. So what does it mean? Don't get confused, please. So I'm just telling you that this ARR and your accounting payback period are very related to each other, because it takes me around 4 years to get back my money, and each year I'm getting 26% of return on my investment. So when I'm going to read book and also see this presentation, I hope you will understand it better how they are related to each other. And your AT assignment, you need to exactly calculate your payback period plus IRR. Okay, so this is example about IRR. Accounting rate of return, of course, has its limitations, and there is just two. First of all, the assets net income may be different from year to year, because here we had a yearly same net income, and the accounting rate of return ignores as well as the payback period time value of money. So it's like weak points and limitations, let's say. Okay. Here now we're going to do one more example practically together, just to understand better once again how we do it. And then we're done with this chapter, because it's quite short chapter, as I told you. It's very interesting, but very short, because we only study really what we need to study from the chapter. And end of this class, of course, I will give you also your problems, which I recommend you to do in order to understand how it works. Okay, so we have this example. We are facing this scenario that we are kind of hesitating, should we purchase a machine or not? And we have a cost of 180,000, so cost of the machine. We have a salvage value of 15,000 and annual after-tax net income 40,000. So we assume that net cash flows occur uniformly over each year, and the company uses straight line depreciation. The question is, what is machine's accounting rate of return? We need to remember the formula, which is annual after-tax net income over annual average investment. So annual after-tax net income in our case, which is already given, will be 40,000, of course, and annual average investment will be cost of your asset plus salvage value over 2. So we have cost, which is 180,000. We have salvage value, which is 15,000, divided by 2. We're going to get 40,000 over 97,500. And your ARR will be 41%, which is really high number. So it means that yearly your return on your income generated on your capital investment is 41%.